Hello everyone, and thank you very much for joining the first in our FX Markets Leaders webinar series, where we will be discussing the highly anticipated transition to a T+1 settlement cycle for North American securities, and what implications this will likely have on the foreign exchange market. My name is Joe Parsons. I'm the Deputy Editor for the Markets Desk here at Risk.net and FX Markets, and I'm delighted to be moderating this panel. Today, we have representatives from the industry that have really been looking at this topic inside and out. First up, we have Lisa Danino-Lewis, Chief Growth Officer at CLS. Then we have Melody Martinez, who is Global Head of FX Institutional Sales at BBVA. Also here is Aziz Arib, Director of FX Products within Citi's FX Overlay and Custody business. And finally, Paul Maythern, who was most recently the Global Head of FX Trading and Co-Head of Markets for EMEA at BNY Mellon. Thank you all so much for taking part today. And so for our viewers, a couple of housekeeping points. We will be running a few live polls during the session, and the Q&A function will be open throughout. So I do encourage you to get involved in both of these. So the move to T+1 is less than 5 weeks away, and there still seems to be a lot of uncertainty. It's been made clear in various public forums and reports that this will impact the FX-related trades that investors use to fund the purchase and sale of the securities, because the settlement will also shift from T+2 to T+1. Now, this is set to have various implications, most notably for European and asset managers, not just from a settlement and operations perspective, but also from a trading and liquidity perspective. So in this discussion, we will go into some detail about the level of preparedness and understanding that the industry has over some of these things, and look at what buy-side firms plan to do in response to them. So let's set the scene, and I'd like to first turn to Lisa, as quite rightly, this is a massive topic for CLS. And I saw recently, last month, there was a report, and this was from the European Fund and Asset Management Association, that kind of found that roughly 40% of daily flows from European asset managers could be affected by this. But at the same time, I believe CLS have also been undertaking their own survey to find out what the knock-on effects will have on the CLS settlement service and what changes, if any, are needed. So could you summarize some of the key findings from this survey and explain where this leaves the market at the moment?
Sure, Joe, and thank you. So late last year, post-summer, we at CLS investigated the feasibility of adjusting some of our operational timelines to try and help support the market. So just for background, we looked at the flows that go through CLS on a daily basis, and we settle on average $6.5 trillion every day. We looked at the flows and tried to estimate what might be impacted by the US move to T+1 for securities. We don't understand, we don't see the rationale for a trade. So the best estimate we could do was to say, actually, which transactions do we have that have a fund as one of the counterparties to that transaction, and the dollar as one of the currencies involved. Now, that sort of aspect, or that sort of amount of trades that we pulled for that analysis, is probably larger than those affected by US securities, but it gave us an indication. And we looked at two different factors there. What currently happens on a T2 basis today that we assume, given no changes in the way that those trades are processed, would be able to still be executed on a T1 basis, obviously taking into account later cutoff times and what might trade later in the day that won't reach CLS, and also what currently is executed on those parameters on a T1 basis that then would go to a T0 potentially. So from the spot side, the numbers there came in at around 2.6% of our average daily value. We assume, again, if those parameters stay unchanged, they'll go T1 and they'll still settle through CLS. The main focus for us was what was T1 today which would likely be pushed into T0 if there was no change in behaviours. And that accounted for just under 1% of our daily average daily value. So we looked at what was possible in terms of adjusting our processes, which is the key one for the market is the initial pay-in schedule, which is where CLS goes through the multilateral netting process that we do amongst our members to crunch down that 6.5 trillion into a much more manageable amount that the market then, or our members then, have to fund to facilitate settlement. The multilateral netting process happens just after midnight CET, and then post that, we have a liquidity tool that we run that further enhances that netting efficiency. And on the whole, across the system, it takes that netting efficiency to over 99%, which means for our members, they have to fund less than 1% of the daily settlement amount. So we went out to all of our 74 members. We can only do what our members can support, because we can't conduct the multilateral net for only a number of our members. It has to have all or none in, because otherwise it impacts. And we asked a series of questions to say, can you support, a move to the initial paying process? We've just published the results of that survey that was done in the last month. Unsurprisingly, it was very mixed across our membership, and that reflects, I think, the diversity of our members. Interestingly, though, over 40% of our members, that actually represent 50% of the average daily value that we settle on a daily basis, said that it would be a significant lift, would need development, and there was a significant amount of that, a percentage of those that said it would be 9 months or more. In fact, one of our top 5 noted that it would take them over a year to make the necessary changes. So, there's lots of aspects that go into that. It's not just necessarily a technology aspect. There's operation, there's liquidity funding. Each member deals with these in very unique ways, not something that we at CLS are privy to, but very important that they can still manage to fund CLS settlement, because obviously, again, settling 6.5 trillion a day is no small endeavor. One of the things that we were very clear with the market right at the beginning of this journey is that we wouldn't be able to move by May, because of, even if all of our members were aligned to us potentially moving some of those deadlines, there'd be a bigger process involved, aligning members, then being able to do development, regulatory approval, etc. As we announced, as I said, in the last month, given the time frame and what we estimate to be the impact, we are going to take a wait and see approach and measure the impact of the move to T+1 before looking at any further analysis and discussion. So whilst we won't necessarily be moving that initial pay-in schedule deadline for May or shortly thereafter, it is worth noting that there is nothing that precludes our members from inputting submissions, so trades, up to 6:30 CET on the day of value. That is down to each and every member to do that. That's their own choice. That may impact their initial pay-in schedule calculations, but we also issue a revised pay-in schedule at 6:30, so that will take into account any transactions that go in between that time. Of the 1%, and going back to your opening comments, Joe, where you mentioned the AFAMA report, of the 1% that we have assessed that we feel that may be impacted of CLS's flows that we see today, through our outreach to the asset manager community, we think from the feedback that we've had, around half of that will still be able to go into CLS for safe settlement. A number of those asset managers we've spoken to have put the necessary steps in place to ensure that they can make deadlines. We've heard some positive news on some of the custodians as well in terms of moving some of the cutoff times that support that. So that's positive. So again, we estimate probably around 0.5% is likely to potentially move outside of CLS settlement. Something, as I've said, we're going to monitor as we go through May. We're going to have a couple of checkpoints, one in June and one in September, to assess what we've seen. Obviously, if there's something that happens earlier that is surprising, we will look at that a little bit sooner. But I think that gives you a good sort of background from the settlement perspective of where we are, how we've got to where we are, and that journey and the input that we've taken from the market, both from the members of CLS and also our asset managers.
Yeah. Yeah. Okay. Fantastic. Thank you so much for that summary, Lisa. I mean, I'd like to bring in Melody and Aziz to this as well, because it'd be great to kind of get your perspectives on some of the things that Lisa mentioned. The findings from the CLS survey that Lisa just mentioned kind of align to your views about the impact on settlement operations, and how that will affect buy-side clients as well.
So I thank you very much, Lisa, for that, and hi, Joe. Indeed, those numbers seem very positive and quite encouraging. I guess, we'll have to see what happens post the start date, because right now everything that we can see or that we can really review is just a little bit of the idea of what we have that's in place in the CLS world. We need to think that there is other currencies, non-CLS eligible currencies that could settle as well against the dollar due to buying US securities. From that perspective, it is encouraging to understand and to hear that it seems that most of the asset managers have made moves to be prepared, right? I think maybe, unfortunately, the settlement process may not be as easy as we may all think initially after the actual start date, right? We're talking, at the end of the day, US securities, a product that most of the world wants to buy. And by most of the world, we're talking asset managers in Asia, we're talking asset managers in Europe. And obviously, asset managers in the US do not have an FX issue, the T+1 move, and the asset managers in Latin America still have time within their day to be able to do these trades, right? So, as you just mentioned, Joe, from a settlement perspective, I think there's still maybe changes that need to be made, obviously, to be able, if you are outside of the US time zone, be in Asia or in Europe, it really does mean that your day concludes a little bit later than before, right? To be able to make good to that FX trade that's needed to buy the US security. And in order to do that, well, clearly, you either have a stronger settlements team in that time zone, or you transfer all of your flows to the custodians who may have a stronger position in that time zone, right? And at the end of the day, everybody has been pre-warned that this was coming, but this is a very difficult decision to make anyway, and not one that's made lightly. So whoever does have very large positions in the US securities market probably started working on this immediately as this was announced, and probably some of the asset managers that maybe invest a smaller percentage in the US securities may be struggling at this point to finalize this particular decision that they need to make, right, to go in one direction or the other. Both of them could be costly in one way, manner, or form.
Sure, of course. I mean, sorry, please go ahead.
I would like to jump on the point made about the buy-side preparedness, right? Surveys show that FX funding remains one of the biggest concerns to foreign investors. And we see overall a high level of operational readiness in the US, much less in Asia and Europe. We've seen as well that the top tier asset managers have been very good at engaging and reaching out to their service providers, including their custodians, CLS, and other key industry participants in trying to understand the impact of T+1, with the aim, obviously, to be better prepared for the change. On the other side, we see much less initiatives from small to medium-sized companies, which makes us believe that they may be underestimating the FX funding impact of the change, and that could lead to serious consequences. Yeah.
Okay, very interesting, because Citi have run their own various reports on this. I think when I looked at it last year, there was the kind of overall finding, there was about 40% of firms had felt that they were unprepared also for the rules. I mean, you know, a year on, how has that number changed at all? Is it improved in any way?
It's very difficult to say. We're getting very, very close to the transition date. Obviously, not only in the US, but also for Mexico and Canada as well, which have obviously the same constraints than US dollar, right? So we do have regular interactions with clients, discussing the FX funding impact and what solutions can be made available to them. Obviously, the clock is ticking, so and we do encourage all clients, buy-side firms, to reach out and discuss the FX options available to them.
Yeah. Okay, perfect. This is a good time to really bring up our first poll question, and this is really around the level of understanding or what T+1 will have on FX trading and operations. So how confident is, this is for the audience, how confident is your understanding of the implications that T+1 will have on FX trading and operations? Very confident, somewhat confident, or not very confident? And while we get some results from that, and we can dissect those as well, yeah, it'd be really good to, maybe Aziz, I'll come back to you as well, to just look at the various costs that has been discussed, that's been associated with this move. So from your conversations with the buy side, how have they begun to analyze what the costs could be from a pre-funding and liquidity and cut-off times, some of these things?
Yes. Clearly, buy-side firms, and again, I'm talking about the top tier, who have been engaging and set up working groups to assess the impact of the change, I think have a good understanding of what T+1 means to them. I think the increase in cost may be inevitable. I think that's pretty much understood by now. First of all, we do expect much more demand for US dollar liquidity at late New York hours, post equity market close, and at a time where liquidity is constrained under the existing market structure. So it's likely that we will see wider bid-offer spreads, at least in the short term, which will translate into higher execution costs for the buy side. Similarly, settlement compression also means that those buy-side firms will have much less time to conduct their post-trade processing, including the FX funding. So what that means is that a lot of those clients are currently reviewing their existing processes and see how they can automate a large part of those steps, because clearly investment into automation and straight-through processing solutions to address those post-trade inefficiencies is really becoming key. Those investments can be done internally or through third-party vendors or even through the custodian. with the aim to obviously speed up those checks, those processing, and ultimately the FX funding.
Yeah.
And we all know that obviously investment into technology comes at a cost. Similarly, we expect the custodian CLS cutoff and the CLS deadline to be more difficult to adhere to, leading to more bilateral settlement and therefore more settlement risk. The point here is that for buy-side firms trading FX with a panel of third-party FX brokers, they'll have to ensure that the cash settles within the custody cash accounts by the custodian cash cutoff. And if the wiring is not done, if the cash doesn't settle by the custodian cleared cash cutoff, then the underlying securities trade may fail, or for clients who have a credit facility with a custodian, their account can be short and they may incur an overdraft fee. So
sorry, Aziz, I think we might have lost your audio there, but yeah, maybe Melody, maybe I'll just turn to you because there was several interesting points that Aziz raised there. What's your take on those?
Sorry, I was just going to say, sorry, just to finish, right? I'm sorry for the technical issue. There will be as well mismatches in settlement cycles, and that obviously mismatch will create funding gaps that buy-side firms will have to fund. For example, a client selling security settling under T+2 to fund the purchase of a US security settling under T+1, there is a one-day funding gap that will need to be obviously funded by the buy-side firm. And those funding mechanisms, as we all know, come at a cost as well.
No, indeed, I have to agree with Aziz. Every single one of his points are on point, to be fair. If we, just so that we understand the cost question that you first asked, right, Joe, from the beginning to the end. Yeah. So we start from what Aziz just mentioned, right? So you have a settlement mismatch. That already has a cost because maybe it means that you need to pre-fund already, right? So there we have our first maybe extra cost that we may not have had in the past. Mm-hmm. Then we reach a point where we obviously want to buy that US security, and that means that on trade date, we need to complete an FX transaction because we have to assume that the investor's foreign. So here comes the FX angle that we're discussing today. And like Aziz mentioned, exactly the time of day when historically there's little liquidity, right? Europe's already closed. That means that at this time of day, the end of the US time zone, we are looking at much more liquidity. There's an extra cost because obviously your FX has much larger spreads, right? At this point, you're talking that you've got the extra cost probably of either the fact that you've had to increase your settlement team in this particular time zone to be able to make good on that CLS eligible currency with the CLS deadline, okay? So either that or you've had to transfer more of your business to your custodian. Again, one or the other is going to produce an extra cost, right? It's the cost of your extra settlement team in that time zone to be able to deal with a larger amount of trades at that time of day. And then you have possibly, if you don't do that, then more business that you give to your custodian, which is fantastic, but it means that it will be a larger cost because you will have to pay your custodian more for having to deal more trades on your behalf, right? And this kind of continues round because this whole process will have STP post-trade, so straight through processes. If you want to ensure that the trade that you completed reaches every single settlement system that it needs to reach on time, then, like Assis mentioned, you will have to invest on technology, because you will have to have straight through process. The moment that those trades are booked, immediately, as quick as possible, they need to reach your custodian or your settlement team as quickly as possible for them to be able to settle that trade on time. And I don't even want to start if it's a nation currency and is a non-CLS eligible currency, right? And then you're talking that for the Asian investor, you move into a T+0 situation. Again, then your time cycle is even shorter. So all these costs that we're mentioning, first thing in the day in Asia, including the FX spread, so the second point that we mentioned before as far as costs are concerned, then that spread is also quite wide in that time zone, right? So from that perspective, I completely agree with Assis. You're talking quite a few processes within the full cycle that will mean extra costs.
Yeah, of course. When we mentioned about spreads, it'd be great to pass this over to Paul from the kind of the market making perspective. I mean, if you have kind of FX trading happening later in the day, I guess how's that going to? What are we going to see in terms of spreads, and how long do you think it will be until we see that kind of normalization around that time?
Sure. Thank you, Joe. And I guess before I get started, I'll have to admit that I answered somewhat confident to your poll question, that I'm somewhat confident in the implications of this move to T+1. And I think we all have a degree of, there's a lot changing, so we want to see what happens. But when it comes to the spot market, then I think the clear answer is that bid-offer spreads late in the day will be a little bit wider. And here I'll just try to sort of peel back the onion of that statement and see how I got there. In that, first, let's size the problem, right? So, 20% of U.S. securities are owned by foreigners. So that's roughly $12 trillion for the U.S. equity market. And then roughly a quarter of U.S. equity flow in the underlying securities for the S&P 500 or the Russell 2000, they actually exchange hands 25% in the last 30 minutes of the trading day. So there's a good amount of volume occurring at the end of the day. So you put those two together, you get roughly $3 trillion of foreign ownership that could be traded. And within that, you can't know how much of it is actually needing to be FX funded and how much of it is being turned over on any given day. But it does, bring the point that these things tend to change hands when the markets are stressed and when there's more going on. So the volume tends to peak, and those will be really, really interesting times. And that's compounded by the actual state of the FX market at the time when this volume was going through, which was mentioned by Melody before, that the equity or the FX market, the biggest market in the world, $37 trillion exchanged every given day, is very much most liquid during the New York and London crossover period, and then becomes less liquid as the day goes on, so much so that it's roughly half as liquid in the New York close. And it's precisely at this time when foreign asset managers, who usually trade their FX after they've done their equity trades, would need to be transacting. So it just makes sense that it would be a slightly wider market. But I guess the good news is that the FX spot market is a continuous risk managed market. And so it's something that the other side is always going to be there. And you're just talking about a marginally wider bid-offer spread in placid times and a more material widening in times of stress. That's it. Back to you.
Yeah. Okay. Fantastic. So I think we've just started to get some results back from the first poll. And Paul, I think you're in the majority there with 56% of people somewhat confident. Which we all are. But there's 20%, still very confident. Surprising, still not, pretty much the same, not very confident as well, which hopefully they could learn a few things from this webinar, but still maybe a little concerning that some people are still not very confident on that. So Lisa, I mean, when we're talking about the costs as well and some of the assessment risk around that, I mean, if a trade can't be netted in CLS, obviously that's going to raise costs there. So I guess, have you been having any conversations with custody members or buy-side firms or banks as well about what they can do to minimize some of those potential settlement costs?
Yeah, we have. I mean, I think as Aziz mentioned earlier, obviously if transactions can't get into settlement for CLS, then the option is to bilaterally settle. Obviously, that would either be gross or net. Again, the more you can net, the more efficient it is for you, but you need to, going back to some earlier points that I think both Aziz and Melody mentioned, the more straight through processing you have, the more automated your processes are, the more efficient you can be, even on the bilateral settlement piece. I mean, interestingly, when we looked across, and I can only speak again for the community that settle within CLS, we've got over 500 asset managers who do. When we looked across that 1% to say, actually, where do we think that might be affected in terms of what region? Within Europe, about 37% of that 1% accounted for about 37% Europe. The UK was only 10%. Switzerland, just under 2.5%. And then when we go into APAC, the amount that we see that could possibly be impacted is much lower, 11% in Japan. But outside of that, the biggest there was the Australians, just over 3.5%. So the percentages really tail off, I think. I think obviously because of the time zone challenges that were already there for APAC, I think there are some other methods and processes that they use to put in place. But effectively, you know, if your transactions are T0, they have to go bilaterally. It's all about automation. We obviously within settlement, we can't offer T0, but we have our CLS net tool that offers bilateral net settlement in non-CLS currencies. So going back to Melody's point, there is that risk around non-CLS currencies, but also for T0 in CLS currencies. And we're seeing about 17 to 20% of the flow that we see through that platform today being T0 trades. Now, they're obviously not US security impacted, but it just shows that there is already some fairly widespread use of the participants on that platform for mitigating T0 risk there. So I think that's one way to be more efficient, but obviously to embed that technology takes time and effort and cost as well. So that's something that I think, you know, participants have to consider. Yeah.
Okay, fantastic. So let's move on a little bit to the trading angle of it as well. So Paul, I mean, when we're talking about on these kind of T1 and T0 timelines, I mean, do you think there'll be demand for same day liquidity? And you know, how do you think
Certainly.
firms could trade
Certainly.
under that?
Yeah, certainly. So I think the biggest impact here is that a lot of volume that's currently being traded as TomNext will have to be traded as overnight. And the overnight FX swap market is not a continuous risk managed market the way that I described the FX spot market before. And the reason for that is because the market makers themselves have their own regulatory obligations that they need to fulfill. And so the prudent way for a market making desk to be run that's quoting this stuff is for the traders to come in at the beginning of the day and essentially square their own positions and try to keep them square to the end of the day so that they don't have any problems for their own institution. So if you then combine that last statement I just made with the idea that there's more need for overnight FX swaps, especially later in the day, at a time when the market makers themselves don't actually have inventory to absorb this new flow, then that I would expect to be quite problematic because it becomes a hot potato type situation where the new flow that comes in can be absorbed to a certain degree by each market participant, sort of squeezing in whatever they have left. But if we're talking about bigger numbers, again, in the time of stress, and you expect there to be more need of this at those times, then all at once it can be overwhelm the market capacity. And that's where this gets really interesting for the funding markets, for sure.
Yeah, I mean, from the kind of liquidity banker side of things, I mean, would they, you know, if there is that kind of influx, or you know, late in the day for kind of TomNext swaps or overnight swaps, and there is a level of volatility. Will market makers be able to warehouse that kind of risk, or could they face any challenges on that side of things?
Yeah, so I guess this is what I'm trying to describe, is that unfortunately it isn't an aspect of warehousing, in that there is a number that needs to be at a certain value for each bank at the end of each day. So it's not something they can just sort of hold to the next day. And there are a few solutions there. So here we're assuming that the underlying client actually has foreign currency funding that they just simply want to exchange for dollar funding. It could be that they're actually doing a money market loan for that in the base currency as well, or also in dollars. But these are also adding portfolio drag, as Melody mentioned before, because yields on overnight money market loans are north of 5%. So for one day or even over a weekend with a holiday, it becomes 3-4 days. It's a good amount of drag on the portfolio. And it's something that I think will need to be watched here, because the end of day has a series of deadlines, cutoff times, end of market times that are important for the whole market. And at that time, the market makers themselves also have to be square and don't have an unlimited capacity to take on what the clients need to do.
Okay, interesting. Very interesting. Thanks. So yeah, I mean, Melody, what's your thoughts on that as well? I mean, have you had some discussion with clients about for intraday liquidity or kind of Tomnex swaps and some of these kind of things?
Well, funny enough, because obviously we have a large amount of Latin American clients, being BBVA, we've worked on T+0 and T+1 basis since ever, because that's how that world, those clients actually work. So all of our systems are prepared for T+0 and T+1 settlements, actually. But when we discuss exactly that conversation with our clients in the US or the clients in Europe, and particularly the clients in Asia, that's not a world that they're so accustomed to. So I completely actually agree with Paul in that the particular liquidity in that particular time zone is going to be very difficult for certain trading desks, okay? And not always will they be keen to be doing very large volumes, like Paul mentioned before. And exactly because of that, we will have to see really how much volume is being done exactly on a T0 or T+1 basis, or how much is actually being pre-funded and then not needed to be done at such a short time period, only just because we may find that if there's a large influx, maybe not all the trades will be completed, definitely not at desired rates. And if we're talking very, very, very large volume, very undesirable rates, if they really have to be done. So 100% agree with Paul there, actually. A really interesting to see what's going to happen in the first few weeks, because that's what's really going to stress the market. And we're going to find out then exactly how much of it is on a T+1 basis and how much of it has actually been pre-funded and already been traded, the FX market's already been traded, because that's very important to know exactly how much the market's going to be stressed by these volumes.
Mm-hmm. Okay, very interesting. Aziz, I mean, what conversations have you had with clients on this? Has there been some explanation about how these kind of same-day trades could actually work?
We do expect more demand for same-day trades. For clients looking at pre-funding, then they may need to book same-day trades on T0. But also for clients in Asia, they may need to book more same-day trades on T+1. And listen, everything which has been described is 100% agree with that. Clearly, the challenge from the buy side of booking same-day trades is that it's adding additional pressure, right? They're going to have to monitor carefully all the relevant cutoffs, right? how much liquidity can my existing FX broker deliver on same day? What's their execution cutoff for same day trades? And what is the custodian cutoff for clean cash payments, right? And they have to look at them on the same day very, very, very carefully, right? Because if you book the trade with the broker, but you haven't wired the cash on time by the clean cash cutoff, your account is going to be short. So they're going to have to anticipate all those cutoffs and book the trade as early as possible and wire the cash as soon as possible as well. So we haven't discussed yet about the management of currency holidays as well, where unfortunately, if there is a currency holiday on T+1, clients may need to pre-fund for some of them. So and therefore booking same-day trades on T0 might be required. So again, I think additional pressure on the buy side, but I think Paul have described as well what we see as the impact on the sell side. There has been a number of a lot of discussions on the sell side in order to better understand and be prepared for any shift in clients' trading behavior. So if there is, as we already described, if there is more demand for liquidity in late New York hours, I think it's highly expected that market maker and the sell side will follow. It's like, you know, any other market, liquidity begets liquidity. So, but in the short term, I think the buy side have to be prepared and expect wider bid-offer spreads, but we believe like there is a strong chance like that liquidity would meaningfully improve over time.
Perfect. Okay, very interesting. And Lisa, maybe I'll go to you next. I mean, have you had discussions with clients and members about managing the settlement risk from same day trades? Is it a different process to what they would what they've been normally used to?
Well, again, as I mentioned earlier, Joe, I mean, it's not something that comes into CLS settlement, although, as I did note at the beginning, at the opening, our members can submit trades up to 6:30 a.m. CET on the day of value, so half an hour before settlement begins. I noted a moment ago that we'd seen that shift of some flow into our CLS net tool to help do that from a netting process. But again, I think that's the same day management is very individual and bespoke to each organization. So, I mean, again, Aziz, Melody and Paul, I think are better suited to opine on, you know, how organizations manage that.
Sure.
Certainly from an asset manager perspective, they want a streamlined process. So preferably one process that can work for everything, you know, on a T0 basis. That unfortunately, I don't think there's that perfect solution in the market yet.
Yeah.
But again, going back to that point, netting any bilateral assessment versus gross, if you can, does make sense because it's just more cost efficient. Yeah,
of course. Okay, perfect. Thank you. So let's go to our second poll question as well, and we'll really can look at what the most pressing changes are in terms of FX operations. So, what do you think will be the most pressing change later in the day? FX trading, greater need to pre-fund, or outsourcing FX trading operations to custodians? Three very interesting options there. So, while we get answers to that, Melody, you know, for what are managers doing then to prepare? What are the most kind of common things you're really seeing from a operations side of things? What are they doing?
What, for operations side of things? The clients that we've been speaking to, I mean, this question actually gives me my answer, to be fair, but definitely pre-funding. Okay, that's
Yep.
something that they're looking at what are the cost of pre-funding versus the cost of outsourcing more of their FX. I mean, most of the asset managers affected already have custodians. Obviously, they know the cost of the trades that need to be completed by their custodians, not just settled, but as well transacted, okay, traded by their custodians, because they're two very different things. One is the cost of what they're gonna actually settle for you, which it would be part of your normal cost already. But the second part is the additional that we're talking about here is having to give that FX trade to be traded by your custodian, right? So you don't have to go out to the market to do it in the very last second with maybe less expertise on a very quick market in the very last minute, right? So from that perspective, though, and the settlement, the settlement team growth, okay? So those three aspects are still very much the ones that I had been, hearing different clients saying that they developing into or already were in the process of doing, but each one of them seem to, at least the ones that we've been speaking to, seem to have been going in different directions. So I'm still a little bit unaware and really I'm dying to see, which is the large percentage that goes in one direction of the three mentioned.
Mm-hmm. Okay, very interesting. I mean, Aziz, when it comes to outsourcing, especially using custody FX, probably historically there's been a little bit of friction there between, from a best execution side of things to outsource most of their trading to a custodian. But has that begun to change a little bit? And with T+1 and all the things we've just talked about, that actually could become a lot more common.
Well, these things have changed many years ago already, right? I don't think situation like the offering within custody has changed because of T+1. But clearly, I think custodians, at least the largest custodians, have heavily invested into automation over the past few years. Solutions like AutoFX, direct dealing, API connectivity solutions clearly can help buy-side firms address some of the key challenges we've covered before. Again, back to topics such as best execution, I think when it comes to addressing fiduciary obligations, we always, encourage clients to stick to well-established benchmark fixings. For example, the 4 p.m. WM fixing, but others as well. It's fully transparent. Mm-hmm. Clients have to understand what level of transparency their custodian and FX broker can provide. Price transparency on the pricing source that is used to book the trade, but also for price transparency on any additional fee add-on spread added on top of the spot reference rate, if that makes sense. But on top of that, custodians can also offer FX netting solution. So for clients who have multiple funds and accounts in custody with, for example, Citi as a custodian, it's interesting to understand from the custody provider whether the service provider can net the FX trades across all the accounts and help the buy-side client reduce or at least optimize the FX execution cost.
Mm-hmm. Okay, fantastic. Paul, on that note about SDP and automation, how much can this relieve pressure on managers? And do you think some of these automation solutions being offered by providers would lead to a greater level of outsourcing of FX workflows?
Sure. So look, I mean, automation is certainly the real answer here, because what's happening is the timeline for everything that occurs between trading and settlement is being compressed, which means that the only way to really do this correctly and in scale reliably is to use STP, right? So the industry as a whole is moving to STP related functionality, and I think that makes complete sense. But within that, you know, expecting perfection is a tall order for a giant industry with millions and millions of trades going on, because trades get misbooked, they get duplicated, they get forgotten to be booked. All these things happen, and the consequences of those things happening are now greater when the timeline to fix them is shortened, and you're less able to go through the exception queues and those things. And so I do think that there's a legitimate reason to outsource more of these FX workflows, especially in scenarios where the asset manager isn't necessarily trading US equities regularly. So it's a giant universe. You have investors out there that are primarily involved in US equities, but there are also those who don't do it that often for whatever reason, based on their business model or where they happen to sit in the world. And in that scenario, you're looking at places where the buy versus build analysis of whether you outsource or pre-fund or these things probably tilt in the direction of using more service for market providers.
Okay, interesting. Okay, interesting. Melody, you know, what's your did you have any thoughts on this, and especially when we look at some things like you know, currency holidays, you know, non-US holidays? Do you think that outsourcing trading around, when you do have for a foreign firm that has a non-US holiday, do you think outsourcing some of that trade workflow to a custodian makes sense?
Well, I guess I'm going to start with saying exactly the same that my colleague Paul said when he first started the prior chapter, which is automation is key. I will always say this, obviously, because I've done electronic trading for most of my career. So I've seen it through many different developments within markets in the last 25 years. And automation is normally key for anything that means compressed timelines, right? So trades get done much quicker. Here we're talking about doing them even quicker, and in the future probably we're talking even quicker, right? I don't think the world will stop here, and eventually it will always be quicker and quicker. So automation is always key, and I don't think we can move, or the market can move in the direction of shorter life cycles without automation. And it's not just the key of automation in your company as an asset manager, as an investor, but definitely as well with custodians, right? Because the initial message has to come as quick as possible from the client to the actual custodian and then to the market for settlement. So all that process needs to be as quick as possible, and that's not possible without automation. If you include, you know, Joe, based on your question, if you include the caveat into this equation of the shorter life cycles on top of everything, a non-dollar holiday, so obviously your life cycle is even shorter. So you either have a whole country of, you know, working in your back office and settlements, or unfortunately you have to automate, right? Well, sorry, I shouldn't say unfortunately. That was an unfortunate word on my side. But you definitely have to automate. And this is something that I really do always encourage clients to look at, because the larger cost in the short term will mean lower cost in the long term. So we really need to look at that, because at the end of the day, the more you automate, I know this is going to not sound too nice, but obviously the less amount of human resources that you need as well, right? So from that perspective, what you really need to have a look when you're thinking of automation is the cost long run. And that's very important as the life cycle of all trades, all asset classes is reduced.
Yeah. Okay, perfect. So you know, with 5 minutes to go, and I do recommend everyone there's still time to send in some questions. Let's bring up the last poll question as well, because I think this is a are very interesting as well, because we've been talking a lot about custodians. So are custodian banks looking to amend their own cut-off times? Yes, no, or it's currently under consideration. Yeah, so I mean, this is a very interesting question about which are custody banks looking, across the board, looking to amend their own cut-off times to help alleviate some of these pressures. And Aziz, maybe I'll come to you for this one. I mean, what do custodians and the sell sides, really need to do to also help alleviate what some of the challenges around this?
I'm sorry, I'm just looking at the question. I'm assuming that question is about the custodian clean cash cutoff, right?
Yes,
not about
yes,
FX
correct.
execution cutoff, right?
Yeah, correct.
Yeah. Well, what I said before, as I said before, I think in terms of cutoff, I think yes, I think the expectation may be that custodians have to revise their cutoff, and I know, I think Lisa was already touched base on that. I think some of them have already changed and adjusted the cutoffs, but there's probably more work to be done on that side. And I think it's really important for clients maybe to be reaching out to their custodian and understand whether there is any move on that side, whether that has happened already or whether this is planned before the transition date on the 28th of May. And also, I think we've already covered that there are several areas of discussion within the FX industry to understand and prepare for the change, with the aim, obviously, to hopefully provide more liquidity in late New York hours, which may imply a shift in liquidity between the U.S. market open to the U.S. market close. So watch and see, right? But certainly on the custody side, as I said before, we have numerous interactions with clients. We are very active into having those discussions with clients, understand their concern, and see how we can assist on the custody side, definitely.
Mm-hmm. Okay, fantastic. So let's bring up the results for that as well. So it's encouraging that we see 57% of banks are looking to amend those, with 35% also under consideration, which is very good. I mean, to Ziz's last point as well, I mean, let's also bring up, I realised we didn't bring up the results from the second poll question as well, so we can have a look at that. And it also kind of links nicely with a question we've had from the audience around, what do you think the impact will, if we have later in the day FX trading, what impact do you think that will have on liquidity, and especially as people start to focus more around executing trades at New York close? Paul, did you want to take that one?
Yeah, sure. I think Aziz had a nice phrase earlier. He said flow begets flow. And I think that's really how this works here, in that we're talking about the least busy time of day, or the least liquid time of day for the FX spot market, and for the overnight FX swap market, for that being. But then if more flow goes through, then yes, it can create more liquidity, but it is going to start out at a point that is quite wide and shallow. And as a result, it would take a lot more flow and market participation in that period for there to be a increase in liquidity or tightening of spreads, right? So it's it's a long way to go. Okay,
fantastic. And so another audience question as well. How heavy of a lift would it be to use DLT PVP technology to ensure settlement does alleviate some of this pressure in the first place? It'd be great to get your thoughts, Aziz and Melody, and potentially Lisa as well.
I'm happy to take that one just from a first glance. I mean, for same day, obviously, I think the key is, what are you looking to achieve from a settlement? If a technology can help that process, that's fantastic. But again, we were talking about cost, and obviously moving to a new technology obviously always means results in additional cost. The other thing to consider, and from a CLS settlement perspective, the benefits there is that netting benefit, you know, funding less than 1% of the 100% for gross settlement. If you're looking at a T0 basis, does that technology allow you to maximize your liquidity and funding benefit? That's a key consideration. If it's just speeding up on a gross settlement basis, then obviously you've still got to fund 100%. So I think it's a trade-off in terms of, you know, the cost of what that might mean.
Yeah. Okay, fantastic. So I'm afraid we're all out of time there. There's some very fantastic points raised, and it would be really interesting to see what will happen in 5 weeks' time. But no, I'd really like to thank Lisa, Paul, Aziz, and Melody for joining me today. And who knows, maybe we need another webinar on this in 3 months' time to see what's actually happened. But with that, I'd like to say thank you very much and goodbye.